We're going to learn that there's a lot of deferring based adjusting entries and there's a lot of accrued based adjusting entries. I want to focus on the deferral ones at the front end. This little verbiage you may have put in your Cornell base notes if you want to just write it on the side margins in here. What are adjusting entries for deferrals? Deferrals are either expenses or revenue, so money out or money in, that are recognized at a date later than the point when the cash was originally exchanged. So basically, the money shows up, we're recognizing or deferring, waiting till later when it happens. The two big types are any prepaid expenses, so the money goes out for something that will occur later, or money comes in that we have to produce work later for. So no matter what, money is there, because remember the timeline. The money is there for any deferral-based adjusting entries. It's just that we have to adjust for either the work someone else has performed for us or the work that we end up owing to people that have prepaid us. Let me give the awesome example that actually you guys shared last week. You know, like concert tickets or like Vikings tickets. Vikings season tickets, that is. If I go buy a whole year's worth of Vikings season tickets, I'm a season ticket holder, right? Have I given the Minnesota Vikings a bunch of money? Have they performed all of those NFL games though? Do you see where that liability exists for them? They owe, I don't know how much the new Vikings, how many people can fit in Vikings field? 50 plus, 50,000 plus. That's a lot of liability hanging over. Like what happens if they end up having to cancel a game, which never happens, but let's just say that. Or there's a catastrophe in downtown Minneapolis and you can't even get to the game. Well, that's a problem. And so that liability exists. And then as every game is played, they actually earn a little bit of revenue and then the unearned goes away, just they chip at it a little bit. Okay, same thing with concert tickets. As soon as the concert happens, the unearned turns into earned, excuse me. I like this little bit. I gave you a little teaser of that, and I want you to fill in all the sections or all the headings. Okay, so again, prepaid expenses, accounting for prepaid expenses. It's one of the deferrals because it's prepaid, cash is there before the action happens. Examples of what expenses are prepaid for: insurance, supplies, advertising, rent, and depreciation. Those are the big major examples. Why do we have to adjust? To account for what we used. Don't even fill in the last two yet. Let me explain a little bit more. If I go by 1 year's worth of car insurance, okay? I go by 1 year's worth of car insurance. Very common. It's oftentimes like a 6-month or 1-year policy that you prepay for ahead of time. And then you jump in your car, and if you smash it or get into an accident or hit a deer, who do you call? Your insurance company, and then they come help offset those costs. As 1 month goes by, did you use one of the 12 months? As 2 months go by, did you use it? Whether you actually had to use, like if you had a fender bender or not, you used up 1 month of insurance, and that's why we have to adjust as we use it, okay? Had we not adjusted, here's what would happen. Assets would be overstated, and expenses would be understated. Remember the trial balance? Remember how we journalize, post to the ledgers, and make a trial balance? Had we not adjusted as we used our car insurance, it would look like we still have a huge pile of assets, in other words, prepaid insurance, and it would look like our expenses weren't as much. Did we truly use our insurance? Yes. So if we don't adjust for it, it's going to look like we have a bunch of assets and not as many expenses. So that's what overstated and understated means. What is the adjusting entry? I'm very excited that I finally, I'm supposed to have circled the word contra. As we go through adjusting entries, remember there's always going to be a debit and a credit, and there's always going to be a balance sheet account and an income statement account. Well, in this case, we're talking prepaid insurance. That's an asset, right? Debit balance, credit's the minus. Well, if we use some, we're going to have a credit. There's a credit, so I know debit and credit rules, there's got to be a debit that goes with it. Well, in this case, we're debiting the expense, so it contradicts our asset, or it becomes a contra account. The insurance expense account is a contra account to prepaid insurance, or it's like a, I'm using you today because I have to follow the debit and credit rule and the balance sheet and income statement expense rule. So now let's try this. Let's look at a transaction, make some T accounts, and see how the transactions shake out. All right. Pioneer Advertising Agency purchased supplies costing $2,500 on October 5th. If we buy $2,500 worth of supplies, is that a debit or credit? Did we gain supplies or lose them? We bought them. Okay, now I want you to just stop there. That was a transaction that already happened. Okay, that happened back on October 5th. We would have had supplies debited, probably cash credited. Okay, that happened. Remember, we're not talking December or October 5th. We're talking October 31st here. What's going on October 31st? Okay, and they went on to say, we recorded the payment by debiting the asset of supplies and probably crediting cash or AP. Okay, that happened. That's not the transaction. I just need you to see that that's what the balance was going in. An inventory count at the close of business on October 31st reveals that 1,000 of the supplies are still on hand. So do this with me. My question is, have we used supplies? Because someone counted on October 31st, someone counted that our $2,500 worth of supplies actually is only valued now at 1,000. So did we use supplies? So how much? 1,500. Are we going to debit or credit that? We have to credit it, because if we put the 1,500 on the debit side, would that equal 1,000? It would be a lot more. Okay, I already can see two things happening. I can see a credit and I can see a balance sheet account. What does this bottom part have to be? What does the other half have to be? It's got to be a debit, and it's got to be coming from where? Okay, so I want you to write that down there. We don't necessarily know yet what it is, but we know that those two halves of the rules exist. What's the contra account to supplies when we use them? Supplies expense, you got it. Supplies expense. I see the word expense, which is a plus and minus. A plus on the debit side, a minus on the credit side. Whoa, hold the show. I thought we're on the right side of the T. It's naughty. It doesn't follow the right side rules. It actually looks more like an asset, doesn't it? Okay, so this is the easy part. We know that it's now an income statement account, which an expense is, and we know it's got to be debited. So I'm just going to put it here. I see a credit on this side. I see it's got to be a debit on this side. But let's talk about it a minute. Does that mean that it went up by $1,500? Yeah, it's an expense of doing business. When we use paper, when we use pens, they're gone from the asset, but we got to contradict it somewhere, or in other words, a contra account, and it's the expense of doing business. Take it one step further and now do the actual transaction. The supplies expense would be a $1,500 debit. Write this down at the bottom. And supplies would be a $1,500 credit. Make it so you can see that a little bit better. I get that by doing the T accounts, that's a little overkill, but I want you to visually see it before you just put the transaction in. That would be the journal entry, yes. Yeah, and yep, it'd be at the end. It like, sometimes they'd even open to a new page in their journal, so like J2, and then they'd put their adjusting entries there. They'd be at the very end because this is at the end of that fiscal period, that October 31. What do you think would be a really common mistake that accounting students would do here? I think they do this correctly, but what could you see for the dollar amount going there, Ms. Alvey? Putting 1,000 in. Yep. Now sometimes in adjusting entries, they're going to tell you the number. In this case, you had to figure it out. That's why I draw the T's. Does that seem pretty easy? Let's keep going. Let's do another one. Is there another one on that page? There's not very much room though, so my apologies ahead of time. Again, we're still in deferral. We're still talking prepaid expense where money has been present first, but we're deferring what's actually happening until later. Said on October 4th, Pioneer Advertising paid $600 for a 1-year fire insurance policy. I see a key word there. I see the word insurance. So that tells me the asset of prepaid insurance originally, way back at the beginning of the month, was $600. And notice, coverage began on October 1st. Pioneer recorded the payment by increasing prepaid insurance. This account shows a balance of $600 in the trial balance. And that's true, because we haven't adjusted our trial balance at all. We haven't adjusted for what we've done or used. And it goes on to say, insurance of $50 expires each month. How'd they get $50? They took the $600 divided by the 12-month policy. Okay, or $50 times 12 is $600. So now, unlike supplies, did we have to go hunt for the number this time? They told it to us. They told us that $50 is going to go down every month. Let's mark this up. Is prepaid insurance a balance sheet or income statement account? Do we own insurance? That's an asset. So that's which one? It's balance sheet because this is an asset. I see a credit. So on our contra account, which we're about to set up, it's gotta come from the income statement and it's gotta be a debit. I want you, and I'm going to start to sound like a broken record. You're going to start to hear me say, if I have a credit, I've got to have the debit. If it's coming from balance sheet, the other one has to be income statement. But I'm also giving you confidence in doing that. Like you might go, I don't know what it's going to be called. I don't know what's. But I do want you to know that if you've got a credit somewhere, the other half's got to be a debit. And so even though I'm going to sound like a broken record, you are going to gain confidence in the meantime. What is the contra account going to be? You got it, insurance expense it is. I see expense, that means it's coming from income statement. I saw a $50 credit one place, so this one has to be a debit. But does that make sense to be a plus? Because now we're losing an asset, but we're gaining an expense somewhere of doing business. So take these two that you just did and do the journal entry. I know there's not a lot of space there. Insurance expense is a $50 debit. Prepaid insurance is no longer valued at $600. It went down by $50. So you'd be going into November with how much of a balance under prepaid insurance? Do you still have the $500? No. Now our November balance would be $550. And every month during that fiscal period, it'd chip away by $50 a time. Or just like when you go to a Vikings game, they chip away their liability of owing us an NFL game. We'll get into that kind of deferral in just a minute. Let's learn about the other type of deferral. We're still under deferral. Unearned revenue, like the Vikings ticket, season tickets, like a concert ticket. Money has been there, it's just that the activity is being deferred. Examples of those, please write them down. Rent. Think about that one a minute. When you go off to college and have to pay rent, you oftentimes pay for that on the front end and then live there for a month, right? Magazine subscriptions, customer deposits for future service. So in other words, season tickets, concerts. We talked about this last week, but do performers sometimes have to cancel a concert on their tour? Yeah, they do. If a singer loses their voice, it's going to be a pretty bad concert. And so then the what if, what happens? And sometimes there's a big disclaimer in there that's saying, if for whatever reason this concert can't be performed, you will not have a refund. Ouch. Why is this an adjustment? Unearned revenue, so money in, but yet the event hasn't happened, is a liability until it actually becomes performed or happens. The overstated, understated business, if we didn't adjust, liabilities would be overstated. Like it would be looking like the concert didn't happen even though it did. And then revenues would be understated. So if we didn't do the adjusting entry, that's what that means. Like if we didn't do the adjusting entry, it would look like we owe more, and it would look like we didn't have as much money in. But in fact, we do. What is the entry? Debiting liabilities to make that go down, crediting revenue to make that go up. Remember, deferral, money has been there. Money is on the table already. It's just, let's get rid of what we owe and increase what we made. Let's do the entry, and I think you'll see how this works. Again, this is more of just the vocab that goes with it. Wait a minute, this is in the wrong spot. There we go. I had that slide in the wrong spot. My apologies. Pioneer Advertising received $1,200 for advertising expected to be completed through the end of the year. So basically October, November, and December. They've prepaid $1,200 for advertising that's going to occur over the next 3 months. Is that common, do you think? Absolutely. You go to the newspaper, they'll say, here, run this ad for the next 2-3 weeks or 2-3 months for me. Here's my ad. I'm going to pay you. I'm expecting when I open the Sun Tribune every week that that ad is somewhere in there. And then as every little month goes by or as every newspaper advertising bit comes by, they're chipping a little bit away at what they owe and making money truly instead. Unearned service revenue, which we know is a liability. I'm sorry, I should be using a colored pen in here. Shows a balance of $1,200. Analysis reveals that they actually did $400 worth of work in October. So it's like they're saying October's gone and we did $400 worth of our $1,200 worth of work that you prepaid us for. Now I know I don't have my little T account section, so maybe just find it somewhere. Okay. Make one, draw one somewhere. I'll draw here and erase. Unearned, what are we calling it? Service revenue. Okay. It's a liability, which of course is a balance sheet. Liability is a minus and a plus because it's on the right side. It's following right side rules. We had a balance show up of $1,200 prepaid for 3 months worth of work. Well, 1 month's gone by, right? It reveals that at the end of October, they've actually done $400 worth of work for us. So that becomes minus 400 right here. We didn't have to go hunt for that number. They told us in October, here is what the work was performed. $400 worth of ads. Okay. So I see balance sheet. I see a debit. What does this one have to be? Let's just hang on a minute. What does this have to be? Income statement, and it's got to be a credit. Well, let's put the 400 over here and see how it all shakes out. When we actually do work, what's it called? Actually doing work and earning what we're supposed to be earning is called service revenue. Is that a good thing that that's a plus? Did $400 work? Did we actually earn our money? So basically, when people prepay for stuff, whether it's Vikings tickets or a Carrie Underwood concert, that liability of unearned until the game or the event happens, it switches to earned. Or in other words, service revenue. I'll even have kids sometimes write earned service revenue. And that's okay. It's not officially called earned service revenue, it's just service, but it's basically turning unearned into earned. Now what about the other 1,200? I mean, 1,200, we still owe work, but that's going to happen in November and happen in December. Remember, we're stopping at the end of every fiscal period to say, what happened? What was used? So this entry then is basically this debit and that credit. I'll move all of this junk out of the way and show you the actual transaction. The liability went down and unearned turned into earned. What happens if the newspaper burns up? Do they still technically owe us $800 worth of work? They do. We've prepaid for it. And we'd have to settle that up later. I think this is a good time to pause. I'm not going to completely stop, but before we get into accrued entries, I want you guys to just talk through the deferrals one more time. I'm going to just hit pause. So far this morning, we've talked about money's there. Let's adjust for what we've earned or used. Now we're going to start talking about the accrual side of things, meaning money may or may not be there. We're just going to still adjust for what we've used. Accrual entries are made as revenue services are performed or as expenses happen. More specifically, let's look at revenue. I think that's your next first sheet, isn't it? Aren't we on the revenue side of things? Okay. Oftentimes, rent can be paid at the beginning of the month before actual money has shown up, okay? Or when services are performed, or if we've earned a little interest on, say, accounts receivable, that we've extended time for those folks to pay us back. Let's write in this little chart, basically what I just said, but interest on ARs. So in other words, if we've sold something to someone and they didn't pay us cash, rather they're like, oh, we'll charge it, so that's an AR, we can charge interest on that and make a little bit of money off of them. The reason we're adjusting is because the services are performed, but we haven't gotten cash yet. Remember, on the timeline, here's the accruals before cash has officially showed up on the table. If we didn't do these adjusting entries, it wouldn't look like we had as many assets because no cash has been brought in yet. And revenues would also be understated because it wouldn't look like we have done our work, which we really have. So the adjusting entries here, here's the balance sheet side. We're going to debit assets when we're adjusting for accrued revenue, and we're going to credit revenue. I know this, to talk about it, sounds confusing. I'd rather just do this with you. So let's get rolling. Looks like I've got 2 entries on 1 page, so we're really, really small. So this is accrued revenue. We are adjusting for what we used or what happened. And remember, money hasn't been brought in yet, but we still have to adjust for what happens. In October, Pioneer Advertising earned $200 for advertising services that have not been recorded. So we had some customer come to us and say, hey, do some advertising for us, but bill us. We're not going to pay you cash right now. We still want you to run some ads for us, but bill us or charge us instead. Well, we know when a customer comes to us and doesn't pay with cash, the asset that we own is the eventual right to getting paid. So we see 200 showing up as we've done some work, but we need to get paid. What is the contra account, do you think, to when we actually get paid? I just want to make sure, yeah. Wait a minute. Remember, cash isn't involved at this point. Later on November 10th, it will be. So let's continue this because we needed, this was balance sheet, this was income statement, here was our debit, here was our credit. Like that isn't unlike what we've done in the past. Like we know that if we perform a service, they're either going to pay cash or they're going to charge it. Well, then on November 10th, we actually got our cash. So it's I wrote a little bit too big here. let's do, I'll just do cash down here. On November 10th, Pioneer receives cash of $200 for the services performed. So we got our $200 cash, and then as a result, they wiped out their balance there. So let me just, this debit and credit go together, and this debit and credit go together. So it's almost like, well, what's so different about this? Well, it's basically just saying, hey, if someone wants to charge it, but yet the money's not there, and we adjust for when the money comes in. So the last one that I want to do with you today is accrued expenses. So meaning expenses that have happened but cash hasn't been involved. Let's fill in our little chart. Interest, rent, and salaries, that's the biggest one there. Your employees have earned their money, it's just that they haven't paid them, especially if the month ends before the pay period does, which I think that's the example that we do. Yep. Expenses have happened, but there's not cash involved yet. So they've occurred or incurred, but not yet cash involved. Had we not done the adjusting entry, expenses would be understated, meaning it would look like we had less business expenses, and it would also have liabilities understated, meaning we actually owe more than we do. And there's our adjusting entry, a debit to expenses, a credit to liabilities. Again, doing it, I think, is better than talking about it. We're not actually going to do an entry here, but it just visualizes what it would look like. Pioneer Advertising Agency last paid salaries on October 26th. So here was payday. The employees received total salaries of $2,000 for the 5-day work week or $400 a day. Thus, accrued salaries at October 31st are $1,200, because take a look at this. Here is where our fiscal period ends. They don't get paid. Next payday is not till November 9th. But do we just not care about this? No. They've got people working those days in October. Remember, we're adjusting because we got to stop. We have to adjust for what has happened or occurred before we roll into the next area. So we've got these 3 days at 400. Not a fire alarm. Okay, I thought it was a fire alarm. Excuse me. We have $400, $1,200, because $400 times the 3 days that we need to adjust for, because they happened. We haven't paid them. We're not going to pay them until November 9th, but we still have to adjust for that occurrence. So let me just, actually, I thought we did the transaction. Let's see. I don't think we do. We're just going to keep rolling. I thought the book gave us an example of that, but it doesn't. We'll do plenty of them in tomorrow. Okay, here's another one. We haven't gotten into depreciation yet, but you go drive a vehicle. Does it depreciate a little bit every day and a little bit every month? I mean, if you had to go turn around and sell your car, every day it loses a little bit of value, and certainly every month it loses a little bit of value. And that's what depreciation is. I still think it's crazy that the book throws depreciation at us right now because we spend a whole chapter talking about it. But assume depreciation on equipment is $480 a year or $40 per month. Well, we have to record what gets used. And in this case, it's depreciation is getting used up. Okay. What does this look like? We have a new account called accumulated depreciation on equipment. Which is an asset. Here's where it's getting a little confusing, and again, I wish the book didn't do it this way, but it devalues our asset, okay? Because we're actually going to say right here, here's our $40. Because if you think about it, equipment has a debit balance, so accumulated depreciation offsets that debit balance. Remember, we have equipment, but then this offsets the value of our equipment. So it's kind of like a little side or contra account within the asset world, okay? And here is our, we'll stop.